There appears to be a slight uptick in risk appetite in the Kenyan market, and we saw strong appetite from foreign investors coming in on Friday. 3/4%, 3/4 of the value traded coming from those investors. Now, volumes and turnover were slightly down due to the 4-day work week. We've got another 4-day work week coming in this week. But what is your feelings when it comes to market sentiment at the moment?
Well, the market opened up quite strong at the beginning of the year. Then we fell away with the worst performing index below the Sahara. And we bounced just under 5% since 29th March. It's been really on the back of foreign investor buying, as you correctly note. They've been coming in for the big cap stocks like EABL, the banks, and Safaricom. And they've been on the buy side of this market with Kenyan retail still on the sell side. I, for one, think we're going to trend higher from here. We were oversold below 4,000. However, there are some very high beta macro issues that are swirling around us, in particular the rate of inflation, the price of food, the price of fuel, and all of these are feeding into making sort of macro calculations around GDP quite tricky to call at this point in time. But the market looks fairly valued, a little bit undervalued to me.
Before we drill into those inflation numbers which came out last week, and as well as the increase in the minimum wage which was announced yesterday, let's just take a look at some of the results coming out of banks. Equity Bank, KCB and Co-op Bank all reporting some impressive results there. Equity especially a 73% increase in pre-tax earnings. What did you take out of these banking results coming out so far?
All these banking results beat consensus by a wide margin. Consensus was of the opinion that we'd see a slowdown in bank earnings. Last year, especially, the bond market was a one-way bet. It's become a lot more twin-sided this year. So I think market expectations were for much slower growth, and Equity Bank, KCB, Co-op Bank have all hit the ball out of the park. Equity Bank hit the ball hardest of all. But I think the market is pleasantly surprised by these results. And what you're seeing is a move into more retail corporate lending, which has wider margins than what the banks were up to last year. So I, for one, am pleasantly surprised. And I think these prices look quite cheap. Equity Bank's on a PE of 13 trailing. KCB's on a single-digit PE. Co-op Bank's probably on the most expensive. And looking at those, I think, at this sort of growth rate, if it can be maintained, these stocks look a little bit like a steal.
Banks still to report: Barclays, NIC, CFC and Standard Chartered. What are your expectations? Is this a picture of what's to come for those banks?
Well, I think it's going to be extremely interesting to see whether it's the whole group that's moved higher. I suspect that's what we're going to see. Barclays is another very cheap stock on a price earnings basis. So I think, the banking sector is going to support this index over the next 3 months. And I, for one, expect the banking results that we're going to see to sort of be in this 20 to 40% EPS expansion rate.
Which of the stocks would you be buying into at the moment?
Well, the big foreign investors are obviously supporting the likes of EABL, Diageo and Sab Miller, excited buyers. They cited Africa as the real growth story amongst their portfolios. And immediately after those announcements, we saw foreign investors pile into EABL and take it back above 200. It's well supported at this sort of level. It's not really a value stock, but it's has a rising tide of foreign interest. I think, that I'd look at the banks, I'd look at maybe KPLC, which looks cheap, but there's a lot of supply still overhanging the stock. But the market overall has good value, I think.
Let's move on to East Africa's largest advertising and marketing company, Scangroup, receiving a lot of attention at the moment, rising 5% on Friday to close at 62.50 shillings. Now, full year results were positive there, 54% increase in profits, and expectations are for a strong full year this year. What are your thoughts on that stock? And is it looking cheap at 62.50, given the fact that it's rallied quite strongly over the past week or so?
It's up about 17.5% since releasing the results, which were well received. Bharat Thakra has got a sort of WPP model. He is consolidating the advertising sector, has a lock on it in this region, said that he was going to look further afield into Nigeria and Angola. And really, it is an advertising pure play at a time when advertising spend in sub-Saharan Africa continues to show good growth, both from multinationals and from local institutions. So I think it's an interesting play. It's a little bit rich on a price earnings basis, I do admit, but there's a very, very small float of shares. WPP's Sorrel has 33% of them. There is admittedly a lockup which expires later on this year, but I think investors will continue to have to chase Scangroup because of a lack of supply in this very key sector of the economy. So I, for one, think, look, it's had a nice rally. I wouldn't want to chase it right now, but I would be looking at it with a 50 handle of any kind.
Aly-Khan, let's move on to the broader macro environment that you touched on at the beginning of the conversation. Now, we had the minimum wage increasing by 12.5%. That was announced yesterday. Inflation rising for the 6th straight month in April to 12.05%. Now, what are your thoughts on what's happening in the broader macro environment, given the high inflation that is coming through in Kenya? And what are your expectations with regards to the latest central bank meeting coming up in May?
Well, firstly, the global macro trends, the mega trends, higher food prices. I don't see food prices coming down anytime soon. Crude oil, we import all our oil. I think the risks are that we trade much higher as this Boer's easy curve starts to accelerate again and put further pressure on the likes of Saudi Arabia. So I don't see any relief in these big trends which are impacting our inflation rate, in particular the price of food. We're all looking up for rain. We haven't had optimal rains. If those rains don't come in a meaningful fashion, the inflation rate is going to continue higher. So, we've got some really deep and intractable problems in the near term, and it's adding a lot of beta to any future forward analysis. I think these problems are all over the world right now. You can see it's flared up in Ouagadougou, in Kampala, in all kinds of places. The government had to make a trade-off between second-round effects on the economy and actually stifling and soothing potential civil unrest. I think they made a finely calibrated deal at 12.5%. Whether COTU, the workers' union, are going to accept 12.5%, I'm not sure, because the average Kenyan worker is considerably worse off this year than he was a year ago, notwithstanding the reduction in taxes on fuel and the increase of 12.5%. Mathematically, if you're spending 47.8% on food and food prices are up about 30%, 12.5% doesn't make up the difference. And this is the problem at the bottom of the pyramid all across the globe. So I, for one, think, look, there are risks. It isn't like it was in 2010, which really was a sweet spot, and the government's got to do some fancy footwork. And also you can see that the low interest rate environment's changed. The central bank has been signaling higher rates via the short-term overnight money, which they've spiked to over 6% from just over 1%, which has also strengthened the shilling. They're trying to do exactly that, put some pressure on the inflation rate via a stronger shilling. But when you throw all of those things into the mix, you see something which is a lot more fragile than it was this time last year.